Hi, and welcome to this week's market presentation. Latest news. After a tenuous start to the ceasefire between Israel, Iran, and the United States announced last Monday on June 23rd, tensions have eased as the ceasefire has continued to hold, with both Iran and Israel mostly respecting the terms of the ceasefire. Diplomatic talks and negotiations are set to begin this week as the U.S. welcomes an Israeli delegation to Washington, D.C., while the U.S. is sending a negotiation team to talk to the Iranian delegation. It is difficult to say whether the ceasefire will continue to hold and whether a long-term peace deal can be achieved given the various goals of each party. With reports that the U.S. did not destroy Iran's stockpile of highly enriched uranium, questions remain as to the state of Iran's nuclear weapons program and Israel's position on the matter. On the other hand, Iran is expected to be more willing to accept a deal and negotiate in earnest given its weakened position following the 12-day war with Israel. Onto the economic side of things, the threat of more tariffs continues to loom over the world economy. Countries around the world are now bracing for additional tariffs as soon as July 9th, as the 90-day pause deadline approaches. The Trump administration continues to add uncertainty to trade negotiations and talks, at times suggesting an extension to the 90-day pause could come, at the same time as indicating that additional tariffs could be introduced on top of the reciprocal tariffs previously paused, regardless of the outcome of trade negotiations. The latter point very much adding uncertainty and giving hesitation to countries to sign those deals. China and the United Kingdom remain the only two countries to have reached a trade agreement with the US, with talks with China expected to continue and to build onto the existing framework. Nonetheless, it must be stated that tariffs on Chinese goods remain at an average rate of 55%. The UK, even with the talks and the agreement, will continue to see its exports into the US face a baseline tariff rate of 10%, with additional tariffs on specific sectors. Lastly, trade talks with Canada took a step back over the past few days following the announcement that Canada was pursuing a digital service tax that would impact US companies such as Google and Facebook. And as a result, the US announced it was breaking all trade negotiations with Canada until Canada stepped back and agreed to scrap the tax before resuming talks. Nonetheless, the imposition of additional tariffs on imports to the U.S. would certainly have a negative impact on global growth as well as to the U.S. itself. Weather. Looking at the weather forecast for the next 7 to 10 days, we note that temperatures in Europe over the last few days and expected at the beginning of this week are for very high above average temperatures across Western Europe in particular. Then as we move through the middle and end of this week and early next week, temperatures are now forecasted to ease down closer to the seasonal average, helping reduce the surge in cooling demand we are expected to see in the upcoming days. In terms of precipitation, we continue to see high levels of precipitation in the Nordic region, particularly at the end of this week and early next week, with more limited precipitation across the rest of Europe. In terms of wind speeds, after a good level of wind speeds over the previous week, those are expected to wane in the coming days, likely reducing overall wind power generation. And lastly, looking at the Atlantic tropical weather outlook, we note a less than 40% chance of a disturbance or cyclone forming around Florida. So at the moment, no real risk to US LNG exports or gas and oil production. Crude oil and LPG. Oil prices continue to show very high levels of volatility given the fast pace of evolution and changes in the situation in the Middle East. Prices rose sharply as tensions appear to be increasing with the introduction of the US into the war, and then following the ceasefire announcement on Monday, that risk premium and those concerns eased accordingly. Over the past week, overall prices have decreased roughly 11 to 12% for the August 25 product, with the Frontier seeing decreases of roughly 8% over the past week. Overall, barring any increase in tensions in the Middle East, the outlook remains bearish given the expectations of an oversupplied market, particularly given the plans for OPEC Plus to increase production quotas as it did in June, and then the prospect of additional tariffs imposed on the US by the US on its trading partners, hurting global growth and as a result global demand for oil. Natural gas. In terms of natural gas prices in Europe, looking at the TTF price evolution, we note a similar bearishness over the past week. As we noted before, the uptick in the markets seen a couple of weeks ago, very much driven by the war in the Middle East. And as those tensions and those rig premiums came down, so too did prices. Prices for the foreign quarter, now the Q4 2025 product, came down roughly 17% over the past week. And the same can be said for the 2026 product, calendar product, coming down around 11% over the past week. Overall, erasing the gains that we saw in the preceding couple of weeks. In the shorter term, weather conditions will continue to be a factor impacting prices, with hotter weather forecasts adding additional support to the market. Moving on to the fundamentals, we see that storage levels in Europe increased to just over 58% as of the end of last week, with the injection rate over the last 7 days remaining near the top of the range since 2012 and notably higher than last year. The higher rate of injections versus the previous year has helped continue to narrow the storage deficit, which has now moved to around 18% compared to last year. In terms of total supply and demand, here we note an uptick in total demand of natural gas in Europe, very much driven by the hotter weather and increased cooling demand that rose power sector demand for natural gas over the past week. In terms of the European supply mix, we note an improvement in Norwegian gas flows to Europe, which have now moved up closer to the average since 2019 and closer in line with last year's levels. Now, those flows remain below the highs that we saw in 2022 and earlier this year. As Norwegian gas flows increased over the past week, we've seen a corresponding decrease in LNG sendouts as overall demand was more able to be met without additional LNG imports. In terms of price competition with Asia for additional LNG imports into Europe, we know that the sharp drops in the market in Europe and in the UK have widened the price premium in Asia versus Europe. And as a result, we are now seeing Asian markets being more profitable, particularly for US LNG exporters, which could potentially be signaling a shift in those cargoes from Europe to Asia. In terms of the investment fund positions for TTF, it must be noted that there's a lag in the position reporting versus the current market evolution. So the recent drop in the market has not yet been taken into account in this graph. But nonetheless, we see that as natural gas prices move up in a bullish direction, we typically see an increase in the level of net long positions in the market. Coal. Looking at coal prices, we see here prices coming down slightly over the past week for the Frontier, reflective of the drop in natural gas pricing, making some of the gas to coal switching that we were seeing earlier reverse as well. The supply situation into Europe remains adequate for this time of year and given current demand levels for coal. Nonetheless, the prospect of a hot summer in Asia, potentially increasing demand for coal in the region, could tighten global supplies of coal. EU and UK emission allowances. In terms of emission allowances, we saw a drop in the market in both the European and UK carbon allowance markets over the past week. The European side of things, price decreases were in the range of around 3% week over week, while we saw slightly sharper decreases in the UK market in the range of 5.5%. The drop in carbon prices in Europe and in the UK could be reflective as well of the drop in natural gas pricing, reducing the demand for coal-fired power generation, and as a result, easing emissions from the power sector. Additionally, the slightly cooler weather that we're expected to see in the coming week could further ease some of those emission levels. In terms of those emission levels across Europe, we note an uptick compared to where we were just a few weeks ago, as those higher temperatures across Europe have increased overall power generation demand. But as those expected to ease and on the back of strong renewable power generation, we have continued to see power sector emissions at the lowest levels since at least 2019. In terms of net long positions, those have decreased roughly 18% week over week in the European market, reflective here of the slight drop in prices and the more uncertain outlook regarding future emissions, in part due to the volatility in gas markets, but also with the uncertain economic outlook as the looming tariff threat remains. Electricity. In terms of electricity markets, looking at the German power market as a reference, we note a bearish price evolution over the past week, with pricing following a similar evolution as natural gas. The sharper drops were seen in the shorter term, with the Q4 25 products seeing decreases of nearly 11% week over week. For the frontier, we see more modest decreases, but nonetheless, prices came down nearly 6.4%, similarly erasing the gains that we saw in preceding weeks. Looking at the evolution across other European markets, we see a similar evolution there, with pricing decreasing across the board. Over in the Nordics, another bearish factor in the market has been the continued good levels of precipitation, improving the hydropower outlook in the region. In terms of total demand and residual load, here we see a slight decrease over the past week, but nonetheless, overall demand for electricity has moved up compared to where we were a few weeks ago on the back of those warmer temperatures. In terms of the supply mix, here we note that solar power generation has now reached a new record high share of the total supply mix, with solar now contributing a little over 15% of total power in Europe. As a result, we have seen a decreasing share of particularly fossil fuel power generation as well as nuclear power generation. Starting with nuclear power generation over the past week, we note a drop there, largely driven by the drop in the French nuclear power output over the past week. So far, the stress corrosion issues that we mentioned starting 2 weeks ago have not yet spread to significant numbers of other reactors, but the threat there remains. In terms of renewable power generation and fossil generation there, we continue to see renewable output at record high levels for this time of the year, even though we saw a slight drop over the past week. In terms of fossil fuel power generation, that remains at the bottom of the range since 2019. Taking a closer look at renewable output, we see over the past week a sharp increase in wind power generation owing to those favorable wind conditions over the previous week, to a new record high for this time of year. On the other hand, while solar power generation remains at record high levels this year, we have seen a slight decrease over the past week. In terms of fossil fuel power generation there, we see the uptick in natural gas compared to a few weeks ago, owing to the increase in overall power generation demand, while over the past week, the uptick in renewables, mainly through wind power generation, has eased some of the fossil gas power generation accordingly. Then looking at hydro reservoir levels, we see that improvement, particularly in the Nordic region, focusing on Norway and Sweden there, with an uptick in overall hydro storage levels over the past week. Elsewhere in Europe, we see a positive picture, particularly with the uptick that we're seeing in Switzerland and the record high levels that we see in Spain. Lastly, looking at the guarantees of origin, here we note a sharp bearish movement over the past week. This follows the very sharp increases we saw the previous week, with pricing now moving back and erasing roughly half the gains that we saw previously. Nonetheless, the added volatility in the market is very much being driven by the increased buying activity, particularly that we saw a couple of weeks ago, as utilities and suppliers aim to reconcile their positions for the forward year in particular. That covers this week's market presentation. Thank you for joining.